Hello, economics students. So we're still in our chapter on financial markets. And you'll remember that we were looking at where the money comes from. We talked in the previous chapter about borrowers borrowing money. Now we're talking about where the money that's borrowed comes from. And we talked about how businesses raise financial capital. Now we're going to talk about the consumer and financial capital. The financial intermediaries, those are the banks and other institutions that stand between the depositor and the borrower is going to borrow that money down the chain. So we're talking banks here. Cater to the individual consumer in many ways, but the two most important for our purposes are on the deposit accounts that they make available. I'll wager most of you, maybe all of you, have a checking account of your own. Someplace you earn some money, you can put that in there. And you may have a savings account as well. It's often the case that when you open a checking account, they automatically open a savings account for you as well. And I hope by now you probably all know the difference, right? A checking account is an on-demand account. Typically, you can take as much out as you want. When you've put money in, you get to take your money out as frequently as you like. The two ways that are most common to take your money out are to write a personal check. That's not remotely as common as it was 40, 50 years ago. Those handwritten checks. I would wonder, have people your age even ever actually written a paper check? Even myself, typically I don't do that. It's debited automatically through the other way you can get your money out of a checking account, a debit card. Debit cards are exactly the same as written checks on a checking account. They are simply eliminating the paper, and the merchant, whoever it is you're using the debit card at, is just the same as if you had written them a paper check. And you almost always could do that if you really wanted to. Probably some old fogies still occasionally do that. But the electronics convenience of the debit card, clearly that's going to make it more common. The other kind of deposit account you can get is a savings account, which is not an unlimited on-demand account like a checking account. Virtually always, I suspect always, a bank will want, in exchange for paying you an interest on your deposit, will limit how much you can take out at any given time. Either limit how much or how often or both. My bank, Wells Fargo, I didn't really realize this until I did it by mistake. If you take out more than 3 times a month from your savings account, they will penalize you the first time with a financial penalty, and the second time they turn your savings account into a checking account. They don't want to pay you interest if you're not leaving your money put. Because remember, the bank is going to loan the money you deposit out to other people and make an interest gain on that. They're going to make a profit on the interest they charge for loaning money out. So they want your money to stay in the bank. A checking account that you pay a fee to them to let yourself the convenience of the checking account. Savings account, they pay you money in the form of interest, but they want you to keep that money in the bank where they can use it. So they're not going to let you take it out at will as often and as much as you want from a savings account. The other thing talked about in this chapter where consumers can deposit their money and make a return on their investment is what's called a certificate of deposit, a CD, certificate of deposit. This is sort of like a savings account, but it's even less liquid. Remember that term liquidity? Liquidity is how quickly an investment can be turned into spendable money. The dollar bill in your pocket is 100% liquid. A gold bar is very unliquid. You have to sell that to somebody before you can spend it. You can't just walk into McDonald's and buy your Happy Meal with a gold bar, right? You have to sell it on the market somewhere, get cash for it. So it is not liquid at all, really. You have to sell it to use it. And then there's everything in between. So a savings account is not as liquid as a checking account because there are limits on how much you can take out and how often you can get it. And even less liquid than a savings account is a CD. But they pay a higher interest rate because they are less liquid. The bank wants your money long term, and the longer you give it to them, the more they will pay you for the privilege of using your money. So if you look, for example, at figure 17.4, you'll see there 3 kinds of CDs. Now, these things often come in denominations of $10,000. So we're not talking about, guy working minimum wage at a part-time job, socking away a little money. Put that in your savings account. But if you got $10,000 and you know you will not need it for a significant period of time, that's crucial. Because once you buy a certificate of deposit, a CD, it is locked in for a set time. 6 months, 1 year, 5 years. You buy a 5-year CD with $10,000, you better be darn certain you will not need that $10,000 for 5 years because you can't get it. Well, you might could get it, but you're going to sell it and take a big penalty. It would be bad. You want that money to be safe, and it is safe. CDs are pretty safe unless you put them in a real fly-by-night outfit, and even then, I think they're covered by FDIC. But that 5 years earns you a higher interest rate, much higher than a savings account would give you, twice as much, perhaps, as a savings account would give you, because the bank gets your money for 5 years and you can't get it back. And they can loan it out. They're not worried about you demanding it back. So the less liquid the money you put in the bank is, like a CD is very unliquid. You have to wait 5 years to get it. The more interest you make on it. So if you have tons of money laying around, you know you won't need it. Who knows for certain they don't need $10,000 for 5 years? I don't know. But if you did, you could put it in there and get a healthy interest rate. Now, I have to put an asterisk by that healthy interest rate, because when you look at that chart in your book, you will see that back in the 80s, back when I was starting college, CDs were drawing in 11 and 12%. Now, as you see, it's down below 2%. Why? Well, inflation's a major reason, right? The Federal Reserve Board, and we'll talk a lot more of this later in the course, keeps inflation low these days. And that means interest rates are low. So you just won't make a ton of money on any of those interest-bearing consumer things from a bank. You want to make more money? You can invest in bonds. Remember bonds? You can buy government bonds. Those pay a little better return on the money. The federal government securities are the blue chip investment. That is the safest money you can put safest place you can put your money. You buy federal government securities. The federal government has never yet failed to pay its interest payments. It's gotten close once, not that long ago, but even then, the Democrats and Republicans in Congress reached an agreement to keep it from happening because everybody knows that would be bad, bad, bad. So you put your money in federal securities, you're almost certainly going to get that money back with the proper interest payments. So that's about the safest. You start talking about municipal bonds, that's issued by cities. Pay attention to which city. Most cities are good for the money. A few, not quite so much. Corporations. If you have bonds issued from certain big, safe corporations that routinely make a decent profit, yeah, those are safe investments. But keep in mind, the riskier the investment, the more likely you won't ever get your money back, the more interest rate you make. So a new company with no track record, or a company that's shaky financially, they might issue bonds to get money. They're going to pay you a much, much higher interest rate. These are what are known as high yield bonds, or more frequently, junk bonds. Now, junk bonds doesn't mean they're absolutely worthless. What it means is there is a very significant risk. You buy that bond, you will never get your interest payment, that it will never pay off. Because they are in shaky companies, or brand new startup companies, or very new small companies that just may not make it. but sometimes they pay off big time. You get a 10-year bond from one of these companies and it makes it big. You've gotten a huge interest rate because it was a junk bond, and they paid it all off, and you got your money in spades. Back in the 80s, Microsoft, as a new company, issued junk bonds. All right? But most junk bonds don't ever pay off. So it's like buying a lotto ticket to buy junk bonds in a way. But if you got the money to spare and you're a risk taker, you might make a nice return. But my advice is stick to federal securities and safe corporate and municipal bonds. I'm not a risk guy. But anyway, you don't get big returns unless you take the risks. So there you go. I'm pretty sure I've already talked to you about stocks and bonds like this, so we're going to move ahead. I don't believe I talked to you about what is in chart table number 17.1. So you've probably watched the news occasionally, and they talk about the Dow Jones Industrial Average in connection with stocks. The DJIA, Dow Jones Industrial Average, is probably the most commonly observed measure of how the stock market's doing. What does it refer to? It refers to 30 big corporate stocks. Their prices added together, then average divided by the number 30, and that is the Dow Jones Industrial Average. These 30 well-established American companies. So when the value of their stock goes up more than 30 of them, 20 of them go up, 10 of them go down, that means the average probably is going to go up, right? So you can use the Dow Jones Industrial Average for 30 well-established big American companies. We're talking like IBM and General Electric, things like that, to get an idea of how the stock market's doing generally, because it's 30 well-established companies. May not be the best average, though, because these are big companies, may not reflect the economy as a whole or the stock market as a whole. That's why there is the S&P 500, Standard & Poor's 500. And you guessed it, 500 stocks, big, medium, smaller stocks, 500 of them averaged together, is going to give you a broader picture of how the stock market generally is doing, not just mega corporations with long track records, but the more average stock is going to be more accurately reflected by the S&P 500. That chart also lists the Wilshire 5000. There's actually 7,000. That really is a random sample of all the companies that issue stock on public markets in the United States. So that might be the most literally accurate average. But then again, who buys stock in those little bitty companies, those thousands of little companies? Probably people with more specific interest in them. So the other two bigger averages are probably more useful. On this chart, it also shows you the name of the two major American stock exchanges. One is the New York Stock Exchange. That is Wall Street, right? That is on Wall Street in Manhattan, New York City. The New York Stock Exchange. I think it's I'm pretty sure it's the world's largest stock exchange. It's certainly the oldest in America. There is also, however, NASDAQ. I don't even know I'm sure NASDAQ once meant something. I don't know if anybody uses that ever anymore. But NASDAQ is an online stock market. There's no physical building you can go to like the New York Stock Exchange. But it lists a lot of smaller corporations. So you have to be a pretty well-established company to be listed on the New York Stock Exchange. It's a big event for a company to get listed. They have to prove their staying power. They have to meet some financial regulations to get on there. It's a big deal. But what if you can't get on there yet, or you haven't grown big enough to get on there yet? You can list on NASDAQ. People can buy your stock online through NASDAQ. In the height of the big internet boom in the 90s, all those internet companies are on NASDAQ. And still it is the case that entrepreneurs, companies with big ideas are listing on NASDAQ. Below that, you'll see three more exchanges around the world's averages that it's not just the United States, all economies are linked together. They show you there the FTSE, FTSE is what people say there, Financial Times Shares Index. Oh, I don't remember what the E stands for in FTSE, but in any event, it is the London stock market. Okay, 100 largest companies on the London stock market's average. The Nikkei is the Tokyo stock market's average. And the DAX is the Frankfurt, Germany stock market. So China has its own stock market. Don't mess with that. That is a very risky business. But London, Germany, Tokyo, those are all very well-established markets, as fully respectable and well-regulated as the New York Stock Exchange. So if you're interested in worldwide economics, pay attention to the FTSE out of London, the DAX out of Germany, the Nikkei out of Tokyo. Okay, enough of that for now. God bless.